Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Eli Lilly and Company annual report. Eli Lilly and Company offers a diverse range of pharmaceutical products across various therapeutic areas. The company's portfolio includes cardiometabolic health products such as insulin medications like Basaglar, Humalog, and Humulin for diabetes management. Additionally, it provides treatments for type 2 diabetes, including Jardiance, Mounjaro, Trulicity, and Zepbound. In the oncology segment, Eli Lilly offers a range of cancer treatments, including Cyramza for gastric cancer, Erbitux for colorectal and head and neck cancers, Inlario for breast cancer, Jaypirca for chronic lymphocytic leukemia, Retevmo for non-small cell lung cancer, TYVYT for Hodgkin's lymphoma, and Verzenio for breast cancer. The company also has a significant presence in the immunology space with products like Ebglyss for severe atopic dermatitis, Olumiant for rheumatoid arthritis and COVID-19, Omvo for ulcerative colitis, Taltz for plaque psoriasis and ankylosing spondylitis, and Emgality for migraine prevention. Furthermore, Eli Lilly has collaborations with other companies to develop new products, including Lebrikizumab with F. Hoffmann La Roche Limited and Genentech, Inc., and Ebglyss with Almirall, S.A. The company's extensive portfolio of pharmaceuticals reflects its commitment to improving human health through innovative treatments. Unfortunately, I don't have access to the text you provided. However, I can still provide a general essay on what could cause Eli Lilly and Co.'s stock price to increase in the past year. Eli Lilly and Co.'s stock price has likely increased due to several factors. One major reason is the company's strong financial performance. As a leading pharmaceutical company, Eli Lilly and Co. has consistently delivered robust earnings growth, driven by its diverse portfolio of innovative medicines and vaccines. Another factor contributing to the increase in stock price is the company's commitment to research and development. Eli Lilly and Co. has been investing heavily in R&D, which has led to the launch of several new products and therapies that have shown promising results. This investment in innovation has not only expanded the company's product portfolio, but also enhanced its competitiveness in the market. Additionally, the company's efforts to improve operational efficiency and reduce costs have likely contributed to its increased stock price. By streamlining its operations and implementing cost-saving measures, Eli Lilly and Co. has been able to maintain a strong balance sheet while continuing to invest in growth initiatives. Furthermore, the company's strategic acquisitions and partnerships have also played a role in driving up its stock price. Through these deals, Eli Lilly and Co. has expanded its presence in key markets, gained access to new technologies, and enhanced its pipeline of potential products. Lastly, the overall market conditions and investor sentiment may also be contributing factors to the increase in Eli Lilly and Co.'s stock price. As a leading pharmaceutical company with a strong track record of innovation and growth, Eli Lilly and Co. is likely benefiting from the current market trends and investor appetite for healthcare stocks. Eli Lilly and Company maintains a market capitalization of $945 billion, broadly in line with the industry peer group. Eli Lilly and Company trades at a higher price-to-earnings ratio of 46 times and a higher price-to-book ratio of 39.69 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company exhibits a very high leverage profile, with liabilities accounting for 82% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified by examining the key points summarized from the extracted data. For revenue growth, strong demand for products such as Mounjaro and Zepbound has driven significant increases in revenue, particularly in the U.S. market. Additionally, a favorable product mix and improved cost of production have contributed to revenue growth. In contrast, revenue decline is primarily due to sales rebates and discounts, which have resulted in an $897 million change in revenue for a 5% change in sales return liability. Reductions in net sales and cash payments have also contributed to revenue decline. Geographically, the U.S. market has seen significant revenue growth, with increases of plus 43%, 2025 versus 2024, and plus 59%, 2025 versus 2023. Europe has also experienced strong revenue growth, while Japan has seen a decline in revenue. Collaborations and other arrangements have generated additional revenue, including the Boehringer Ingelheim collaboration and tiered royalty payments from Ebglyss and Orglipron. Overall, the company's revenue growth is driven by the success of its products, particularly Mounjaro and Zepbound, as well as favorable market conditions. However, revenue decline is primarily due to sales rebates and discounts, reductions in net sales and cash payments. The net income of the company experienced a significant increase from $10,590 million in 2024 to $20,640 million in 2025, representing a growth of 98% from 2023 to 2024 and an astonishing 294% from 2023 to 2025. This substantial rise can be attributed to various factors. One key reason for the increase is the higher gross margin, which was partially offset by increased marketing, selling, and administrative expenses, as well as research and development expenses. Additionally, a favorable product mix and improved cost of production contributed to the growth in net income. However, there are also uncertainties surrounding tax positions, potential changes in tax laws, or regulations that may impact future earnings. The profit margins of the company also saw a notable increase from 23.5% in 2024 to 31.6% in 2025, representing a growth of 35% and 106% respectively from 2023 to 2025. This significant improvement can be attributed to the favorable product mix and improved cost of production, which outweighed the increased expenses. The company's financial performance has shown a significant improvement in its ability to generate cash from its core operations. According to the latest financial reports, the company has successfully transitioned into a state of positive operating cash flow. This milestone indicates that the company is now able to cover its operational expenses and invest in growth initiatives without relying on external funding. The achievement of positive operating cash flow is a testament to the company's efficient management practices and its ability to optimize its financial resources. It also suggests that the company has been able to manage its costs effectively, maintain a stable revenue stream, and make strategic investments that have contributed to its improved financial performance. The company's debt levels have undergone significant changes over the past year. Initially, the debt increased by $8.9 billion from $33.6 billion to $42.5 billion. However, upon closer examination of the financial statements, it appears that this increase was due to a decrease in short-term commercial paper borrowings and an increase in long-term debt. The total debt level also saw a significant increase from $33,644 to $42,503. In terms of interest expenses, there is some indication that they may have increased due to the rise in total debt levels. On page 79, it is reported that interest expenses rose from $781 in 2024 to $895 in 2025. Additionally, on page 89, it is noted that interest expenses likely changed significantly due to the increase in total debt level. However, there are also instances where no significant change in interest expenses was indicated, suggesting some ambiguity in this regard. The financial performance of the company varied across different regions and segments. On a positive note, Lilly International, led by Patrick Johnson, performed well, as did Lilly USA under Ilya Yuffa's leadership. The immunology segment, headed by Adrian Brown and Daniel Skavronsky, MD, PhD, also showed strong results. Additionally, the cardiometabolic health segment, led by Kenneth Custer, PhD, and Patrick Johnson, and the oncology segment, led by Jacob Van Naarden, performed well. However, some regions and segments struggled due to various challenges. The U.S. market was impacted by ongoing litigation and government regulation, while Europe faced budget pressures, cost containment measures, and reference pricing. Japan's market was affected by government-mandated annual price reductions and repricings for specific products. China's performance was hindered by tariffs and sanctions, and the EU market struggled with government-mandated cost containment programs. Management's outlook for the company emphasizes a focus on innovation, cost-effectiveness, and improved patient outcomes. To achieve this, they are prioritizing strategic partnerships and licensing arrangements to stay competitive in an increasingly challenging market. The company is expanding access to medicines through new partnerships and digital platforms such as Lilly Direct. However, management acknowledges that intense competition from generic pharmaceuticals and biosimilars poses a significant threat to the business, particularly in the biologics sector. To mitigate these risks, the company is investing in research and development, making strategic acquisitions, and executing ongoing and planned launches. Management is also focused on managing regulatory compliance, foreign currency risk, and interest rate risk exposure. In terms of growth prospects, cardiometabolic health products are expected to remain a significant contributor to business revenues and prospects. The company's cash and liquidity position is sufficient to fund its capital requirements, with capital expenditures increasing in the near term due to investments in global facilities. Overall, management's strategy is centered on driving growth through innovation, strategic partnerships, and acquisitions, while managing risks related to competition, regulation, and market trends. The company has made several strategic moves through acquisitions and divestitures. In terms of acquisitions, the company has engaged in various business development transactions, joint ventures, and equity investments to expand its reach and capabilities. Specifically, it has acquired IPR&D assets, which are intellectual property rights and research and development projects, to enhance its innovation pipeline. The company's acquisition strategy is evident across multiple pages, indicating a deliberate effort to grow through strategic purchases. On the other hand, divestitures have been relatively limited, with only one mention on page 25. This suggests that the company has focused more on expanding its portfolio rather than shedding assets. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. In terms of dividends, the company has consistently paid out to its investors over the years. The amounts have varied, with $6 per share being paid in 2025, followed by $5.20 per share in 2024. Additionally, a quarterly payment of $1.73 per share was introduced in 2026. The dollar amounts of these dividend payments also provide insight into the company's financials. In 2025, the total dividend payout was $3 billion, while in 2024 it was minus $5,384 million, indicating a decrease from the previous year. However, this may be due to various factors, such as changes in the company's financial performance or its dividend policy. In addition to dividend payments, the company has also engaged in share buybacks. According to the data, a total of 1,479,000 shares were purchased, with an approximate dollar value of $1,500 billion. This indicates that the company is committed to returning value to its shareholders through both cash dividends and strategic investments in its own stock. That concludes the financial summary for Eli Lilly and Company. Feel free to comment below, and I will be happy to answer them when possible.